Hi, and welcome to my channel. For those of you new, my name is Dave and I work in financial services. And these videos are a mixture of my journey and development towards financial freedom. They will cover financial products and hopefully financial well-being so you, like me, can reach your financial gains sometime in the future. Now let's get into this latest video. Every day we're being bombarded with bad news. Unfortunately, the markets hate uncertainty. There is an impending recession moving forwards. Firstly, what is a recession? A recession is classified as a significant decline in the general economic activity over 2 consecutive quarters. We're not there yet, but we will be very imminently according to all the forecast economists. The figures in the UK are coming out to support such evidence. If we look at 2022 for the year to date, in January we had growth of 0.8%. In February, growth reduced to 0.15%. In March, it contracted to a loss of 0.1%, and the figures out this week for April were contraction or a loss of 0.3%. Exacerbated by a lot of things: COVID, supply chains, increase in oil prices, shall we say, rising inflation. We've recently seen 4 interest rate rises. In the US, they reckon rates will go up by 0.75% and 0.25% in the UK later on this month. And we've currently got inflation in the UK at 9%. The forecasts reckon it will get to 10%, and in the US of A last week, figures touched 8.3%. So for the UK and America's, record inflation at 40 years high. Okay, ultimately we will see reduction in sales, and things will only get worse. Obviously, as energy caps come in, people have less money to spend, so it will create a very negative problem within the short term. And we've seen that in reaction to the markets. Okay, rising inflation, poor earnings, poor trading figures. And if we look at the following charts, the S&P 500 is down 21.83% during 2022 so far. And the FTSE 100 is down 4.47%. As we've said, the markets hate uncertainty. Hopefully it's a short-term blip, but you, like me, in your portfolios will be seeing a market of red. Losses across numerous shares and funds. So what should we do in the current market condition? Well, first of all, stay calm, don't panic. Markets will always go up and down, and avoid short-term noise and market sentiment. The markets hate one thing, and that is fear and uncertainty. And bear markets usually last a very short time. We've had 15 bear markets since the Great Depression in 1929. We've already recovered, but they do last shorter than bull markets. Don't look at your share prices or indexes every day. It will drive you insane. Switch off from short-term negativity. And think of what your investment objectives are. What are they in 12 months, 2 years, 5 years, and long-term 10 years? What are your investment goals and objectives? And the market normally gives an annual return of 8% year on year. A second thing you may wish to do is create some kind of emergency fund or some kind of safety buffer. Keep money in a bank or building society, especially for short instances, short term. It may well be £1,000, it may well be 3 to 6 months salary, whatever level you are happy with. It depends on your own personal circumstances. You do not want to sell your investments at a loss. 1, to meet short-term bills or essentials or lifestyle events. 1, you're going to create a loss, and 2, it defeats the object of investing. Not only are you selling an investment at a loss, but you will also incur fees to sell them loss. And you will also incur fees when you buy back into the market at a later date. So it's some kind of double whammy. So if you need money to pay your bills, use short-term emergency funds. Do not sell your investments. You may well regret at a later date when they recover, because you need some money in and a short-term emergency, or you're living paycheck to paycheck. Another thing you may well do is reduce what we call expensive debt. In periods leading up to recession, interest rates will rise. So in the US and UK, they will rise next few weeks, next few months. They've already done so in 2022. So your debt becomes more expensive to service. And avoid any undue stress or financial worry. As we said, create a financial buffer. And ultimately in a recession, companies will cut back. It may be the number of jobs. It may be annual pay increases. Okay, it may be overtime. So don't become a statistic. Okay, how will you cover them debts if you lose your employment or if you suffer a drop in income? Okay, what about your day-to-day expenses? Use this situation as an opportunity to get your financial affairs and your debts in order. It may well be you have a great kind of reset. Okay, it may well be some kind of light bulb moment. Okay, how you react to the situation may well pay off in great dividends for years to come because of what we are suffering now as across the whole in the current economic situation. Although the market may well be a sea of red because of losses across new portfolios, you may well see it as a buying opportunity. Keep investing in the market, whether you're doing dollar cost average or you see it as a lump sum to take advantage. If prices drop, ultimately you're going to be buying more shares or more units in a fund at the same amount of investment, and prices will always recover. See it as a great opportunity to increase great companies or funds which are on sale compared to their true market value. The market will recover and it will pay off very handsomely in future years. Okay, a simple example, COVID came in 2020, markets had a downturn, they recovered in 2021 by 30%. So if you bought at the bottom of the COVID, when all the bad news was around, you'll be showing a very nice profit. So can you do the same in the current situation? I personally been buying shares in UK insurance companies. They've been around for numerous years. They're very cash rich. They're considered safe to boring. Everybody needs insurance, whether it's life, car, home, or workplace pensions. But the two companies I've been buying, Legal and General and Aviva, are currently paying dividends between 6 and 7%. And those dividends will be invested back in the portfolio. So next year the dividends will be increased. It's all about creating the power of compounding. So I personally see it as a very good buying opportunity to increase existing shareholdings within my current portfolio. One thing we are doing moving forward within our portfolio, we are also buying a global ETF. Very low cost tracker funds, very low fees, but it's across numerous sectors, so it's away from diversification because our portfolios are mainly solely UK based. You may well be in the same position. If you're not happy buying individual companies because they are showing a loss, buy yourself a portfolio of funds such as an ETF and hold for the long term. It will give you greater diversification. So let's just say you buy S&P 500, it will cover 500 companies. If you buy the FTSE 100, again, it will cover the market, it will cover 100 companies, so it will give you greater exposure, but it will give you a lot less risk in your portfolio. And remember, your portfolio may be showing as a loss, but it's only a loss on paper. Ride out short-term market sentiment. It will pay off thing long-term, okay? A loss is only a loss when it becomes a sale and it becomes crystallized, okay? There's a great saying, time in the market is better than time in the markets. Now, I'm not going to boast or brag, but a quick review of my holdings in the past few years. It just goes to show there are good years, there are bad years. My SIP, my self-invested pension plan, over the past 6 years has given an annual return of 12.33%. Okay, this year we are down 2.56%, but it is down, but it's not been hammered, shall we say, because 85% is in the UK. My ISA, which I've got for the last 3 years, is giving an annual return of 20.92%. Okay, for 2022, it is down 8.74% year to date. Hopefully a short-term blip because of what's happened in the market. But it's been more affected because we are 60% in the UK, we are 25% in the Americas, and we are 15% in Asia and emerging markets. So it's took a bigger hit thanks to our investments in technology shares, S&P shares. But hopefully it will recover. And on a personal level, we are looking for annual returns every year of 10%. So we will have good years, we will have bad years, but all the holdings we own across our portfolios, whether it's shares or funds, we intend to hold between the next 3 to 5 years. We are thinking long term. A quick summary, okay, there isn't a recession coming. You've just got to switch onto the news. You've just got to see the market headlines every day. It's not good news. Who knows what will happen? Recession may last 3 months, 6 months, it may be 12 months, okay? Who knows what will happen about the war in Ukraine, rising inflation, okay, oil prices, supply and demand, shall we say. But think long term, stay calm, don't panic, create an emergency fund, okay, reduce expensive debt, see it as a buying opportunity. Can you take advantage? It will pay off leaps and bounds across numerous years, okay. Remember, if you like the videos, smash the like button, subscribe to this channel, and we'll see you again soon.